Are you looking to put your first dollars into the stock market but have no idea what you're doing and don't want to pay the experts large sums of money to manage yours? Well, I'm hoping to give you an answer to that question in this video. But before we begin, I want to thank you for watching Ben Explains. And if you like this video and want to watch more videos where I explain things, click that subscribe button down below. Now let's get started. If you are not an expert on the stock market or have an MBA, you will probably want to invest your money passively, meaning you put your money into the stock market over a long period of time without touching it. Now I know, the idea of constantly checking the stock market and buying and selling stocks as their market value fluctuates might sound fun, but what you're trying to do when you do this is to beat the market. And even the experts that charge you lots of money to invest for you can rarely do this. But when you invest passively, what you are doing is trying to match the market, which as the years pass almost always trends up and makes you money. Okay, now time for some brief history. The idea of passive investing has been around for a long time, but was popularized by John Bogle in 1974 when he created the first index fund. He later founded the investment company Vanguard, which is to this day one of the largest investment companies around. Now, fast forward to now, and there are two ways to passively invest. You can buy a mutual fund, meaning you give your money to a company that will hold it along with lots of other people's money and invest in a lot of companies in an attempt to match the market. The other way to invest passively is through an ETF, or an exchange traded fund. ETFs are like a stock that matches a certain index, for example, the S&P 500 or the Dow Jones. Generally, ETFs are cheaper and have lower expense ratios than mutual funds. There are three big benefits to investing passively. The first is that it doesn't cost you very much. For example, one of the most popular ETFs is the Vanguard S&P 500 ETF, where all they charge you is an expense ratio of 0.03%, meaning that for every $1,000 you invest, Vanguard will take only 3 cents. There are even some ETFs out there that have an expense ratio of 0. The second benefit is diversification. This is critical when it comes to the elimination of risk. Let's say you invested all of your money in a new startup tech company and it was going great for the first few months. But then a fire burns down their warehouse and they go bankrupt and you lose all of your money. But if you had invested in other companies, they would have helped negate some of your losses. Now I know this is an extreme example, but most ETFs and mutual funds have stock in hundreds or even thousands of companies. So although you may still have had some stock in the company with the fire, them filing bankruptcy would have barely had an impact on you. And that is the benefit of diversification. The third benefit is just how simple it is. You throw your money into the market and don't touch it until you need to. It doesn't take an MBA to do that. And it's effective. Simple and effective are two things that work wonderfully together. Thank you for watching Ben Explains. If you have any suggestions for future videos or any questions about this video, comment them down below. If you enjoyed or learned anything from this video, give it a thumbs up, and if you want to see more videos like this, all you have to do is hit the subscribe button down below. Until next time.